Hello, everyone. Welcome to our Pellegrini Financial fourth quarter market update and really wrap to the 2025 year. First off, hopefully everyone received their financial success for retirees in the mail that we sent out here prior to Christmas. And I hope you got a chance to read through my contribution to the book. We've got a lot of positive comments on it. If you need an extra copy or two for yourself, your friends, neighbors, whoever else, will certainly be glad to send you a few more. Just give us a call and let us know. So jumping into our market update, first off, obviously on the equity side, as we kind of alluded to last call, the Canadian market was leading the way at the time and still did through the rest of this year. So this is the 1 year return at the bottom in this bar chart, and we see the Canadian equities highlighted in yellow. And again, that led at just over 30% here for the year and 2025, which was fabulous. Obviously, some of the other equity markets were strong as well, with the emerging markets on the far right side of that, kind of second behind Canada, then followed by international and lagging by the US. But even the US market was still a strong market on average. Again, just kind of pales in comparison to the rest of the equities. We talked a lot of artificial intelligence through the last year. Of course, we will be again. Just a note on how much that's extended into the U.S. market, and 63% of the U.S. economy now utilizing AI, as the Canadian market is too. And even little small firms like us that we've kind of dabbled into different aspects of how it can work and help our business. Um, Again, it's going to be everywhere more and more, and it's not a bad thing. It is a good thing, and we'll continue to see that across the globe. Obviously, emerging markets kind of benefited from a little bit of U.S. dollar weakness. That's always a bonus to their economies, and again, probably more opportunities in emerging markets here over the next little while as well, based on just where the economy is heading as a whole. When we look at some of the sectors in particular, and this is just Canadian focused and Canadian centric again, obviously it was led by materials, and that's highlighted in green there. Of course, materials are mainly the gold stocks and some of the commodities like that uh, did phenomenal through 2025. And of course, now that gold component really represents over 12% of the Canadian stock market, which is the highest ever. And so, gold, of course, is still, I think, something that has opportunities going forward. Of course, it's been riding quite well through the past year. The only sector that was negative in Canada was the healthcare sector, just nominally, but was negative. Everything else was in positive territory. Most did fairly well, whether it was energy or information technology or financials. Even those other sectors did quite well through the course of this year or this past year. When we look at interest rates and inflation has been subdued now for some time, and so that hasn't been as much of an issue, which is good. It's given the central banks or Federal Reserve's opportunities to be more um, precise on how they were and where they want to cut rates or increase rates, whatever it might be. So with inflation kind of under control, that's a good thing. Now they focus a bit more on employment and things like that for encouraging economic growth. The chart on the left there is just dealing with the comparison of the Bank of Canada rate versus the Federal Reserve in the U.S. So the light blue is Canada, the dark blue is the U.S. Again, Canada now is expected to be kind of in a flat range for a period of time. No increases, no cuts. The U.S. is still expected to have a couple cuts here through 2026 and onwards into 2027, where they are converging a bit more as time goes by. The chart on the right is more of the G7 across the board. And so, you do see a little bit of lock and step to some degree with all those different central banks. And so they are converging a bit more into a normalized rates here over the next this past year, next year going forward. The one in particular I wanted to highlight really was the red at the bottom, which was Japan and the Japanese interest rates, which over the last 2 decades have basically been zero or near zero or negative for long periods of time. And finally, through 2025, we had into positive territory. And interestingly, to see that projected rates where they are, uh, you know, slowly, I guess, gathering closer to where the rest of the G7 is. Just to be positive is a very interesting development in the Japanese interest rate environment. As a whole, we just see yield curves normalizing, where again, yield curves just mean where the near term rates are lower, the longer you go out the yield curve or to the term of the loan, the higher the rates are, and that's as it should be. When we look at some of the employment and GDP numbers, employment in particular here to start with, the top chart here on the left-hand side has been the U.S. unemployment rate, which has been rising through the course of the year. And as I kind of note here in some of the numbers, the manufacturing sectors really are the ones that have lost quite a few jobs, 68,000 through 2025. We saw December improve a little bit, but it's expected to still be some tepid growth in the U.S. employment situation. The chart at the bottom kind of compares the Canadian versus U.S. job growth. And again, from Liberation Day and on, which was in April of this past year. And again, flatness to the U.S. numbers, a little bit of improvement to the Canadian, although it's a little bit more jagged. That's just kind of the scale of our economy too, that causes some of that. The Canadian employment did improve, I guess, in the sense that jobs were added, even though our unemployment rate went up. And at the end of the day, we had a lot more people that just came back into the workforce, which was a good thing. Our participation rate, I believe, is around 68%. I think the U.S. is around 61, 62. And so while we improved and had jobs, added jobs to the economy, I think most were full-time as well, if I recall, our interest or our unemployment rate still went up because of participation back into the workforce. And again, that is a good thing as a whole. When we look at GDP in particular, this is the Canadian GDP at the top on that chart. And so while we went through the middle of 2025 as being basically near zero or near recessionary growth, it came out the end of the year much better. So we had 0.6% on the fourth quarter, which was 2.6 annualized, and projecting to be more than 3% here through 2026. Obviously, the caveat to that is Kuzma, any renegotiation of the trade deal or whatever happens there could change that, obviously. And that's something, obviously, none of us can control, none of us can predict. But at this point, certainly the fiscal stimulus that the government is adding into infrastructure and different things, it is expected GDP to be fairly positive through 2026. The chart on the bottom is just a change in year-to-date exports by region. And so two things here to this chart. The light blue line is to the U.S. And of course, up until Liberation Day, there's a pretty big increase to that year-to-date exports. And everyone basically front-running, obviously, supplies and materials before tariffs were employed. And so come Liberation Day and tariffs, well, we saw a big decrease to the U.S. exports and continued through the year. The exact opposite for the rest of the world. So again, the rest of the world kind of was flatlined to start, but then through the rest of the year saw a steady increase. And I know obviously there's lots of talk here more recently of Canada's deal with China and Qatar's and all that kind of stuff, which again, we've already traded a lot with China anyways, but the idea for getting more trade outside of the U.S. is not a bad thing in the grand scheme of things, and you see that still in the chart and the numbers there below. It is trying to diversify away from the U.S. The U.S. will always be our biggest trading partner. You can't help it; you're right next door, and so that's always going to be there and be our biggest trader. At the end of the day, though, exporting and trying to diversify away from the U.S. is not a bad thing. That includes our energy supplies as well. And so when we look at commodities and energy, this top chart on the left-hand side, it's again very jagged because of the way it's a startup of the oil exports to Asia. That is just oil. And of course, as the TMX came online, obviously there's some jaggedness to it because you're basically testing the pipes and getting through, an influx of oil and then whatever, recalibrating and all doing that kind of stuff. This goes through, the first half and a bit more of 2025. We'll have a chart here that probably shows a bit more as we get through time. And as TMX fills up, obviously, expectation is that line will smooth out a little bit, but also increase in values. And so more and more of it that gets exported to Asia and Asia economies is a good thing. Again, it's another association where we get better value for our dollars, less risk of having one trade partner, and so as you diversify, that's a good thing. We've had obviously discussions on Venezuelan oil and how that impacts our Canadian oil production. Again, the point here in some of the verbiage is the Venezuelan oil market, as much as it might be the equivalent of Canadian. Again, I think as everyone actually realizes now, it'll take a lot of time and a lot of money to bring back Venezuelan production. Even if it ever does get back to its normal production of 3 million barrels plus way back when, It'll take a lot of time and money and stability, which is still doesn't have that in the Venezuelan economy, and of course the government is still the same. Um, when I talk about gold here and copper at the bottom, that's part of this commodity cycle on the right hand side there, which is a projected and assumed commodity cycle run, which may or may not happen. At the end of the day, though, gold, of course, has been well supported through the past year and will go forward based on just even the Venezuela and Greenland situations. More than anything, I look at the bottom line there of copper, and copper remains very strong. And that is, of course, a base metal in lots of different manufacturing. So having a strong copper price bodes well to economic growth. Whether that delves straight into the full commodity cycle, time will tell, but just an interesting chart to look at. When we move on to just what 2026 looks like, I think a few things. We talked about interest rates here, and of course, Federal Reserve expected to cut through 2026 a couple of times, Canada being pretty flat. But at the end of the day, we've seen more of a normalization of interest rates and the yield curve, where, okay, near term rates are lower than longer term rates, as it should be. And so that's a good thing economically from a projecting forward standpoint. The nice thing is too that there's still good yields to be paid even on the near term rates. So again, rates were well past those zero rates a few years back, and so near term rates are decently paying a decent yield, and so that's a good thing for fixed income and our fixed income allocations. When we look at the equities, of course, a lot of these economies, Canada in particular, is looking for, fiscal stimulus being pumped into the economy to build out different infrastructure capital investments. And yes, there's lots of talk on that. We're still looking for action. There's some action there. We'll see how far that goes in the next year or two as well. The U.S. equity market is driven a little differently, and obviously there's a lot of borrowing going on there too, and stimulus in different ways. Obviously, AI, we've already mentioned, is being a big part of that economic engine. And again, that in itself has done a lot to improve profit margins and revenue growth without having to really invest much in infrastructure, investing in technology and creating efficiencies. And again, that will continue to grow not just in the US economy, but Canada as well, small firms like us to Europe, Asia, and everywhere else across the globe. Obviously, the interesting story to AI is the energy consumption it needs to run it. And so now, infrastructure wise, you're looking at how energy production matches with what AI needs it to do. When we look at Asia and some of those other economies, again, while it's a decent economy as a whole, it might slow a little bit more than what it has been in 2025. Again, domestic demand is still there, inflation is contained, and so most of those kind of things are still in a period where there's at least decent growth outlook. I would say emerging markets are probably one that needs a bit more attention and where there's more opportunities, both being undervalued. Again, cheap energy supplies, oil is being, we haven't talked about oil specifically today for pricing, but it is cheap. And that is a good thing for like an emerging market. Again, undervaluation of the markets is still there, and of course, a cheaper U.S. dollar is also good for them, and from a tailwind perspective. And so, certainly, expectation of emerging market allocations as a good opportunity is there in the cards. And so, you know what? From that perspective, 2026 is certainly shaping up to be a decent year. I know as we get through the middle of the year, we're going to talk a lot more about midterm elections in the U.S. and we'll see how that kind of maybe sideways markets for a period of time there as we get into that period of time. But we'll talk about that no doubt in the future. So as it stands right now, 2026 is looking pretty positive and shaping up to be pretty positive to start. Well, we'll leave it at that. We do thank you for joining us and welcome you back for the first quarter market call of 2026 here in a couple months' time. Thank you and bye for now.